JP Morgan has released a sobering forecast that's sending ripples across financial markets. According to CEO Jamie Dimon, the Federal Reserve may not be finished with its cycle of interest rate hikes. Contrary to what many investors are hoping for, Dimon believes there's a 40 to 50% chance that rates could go even higher. If that happens, the consequences could be severe, echoing the chaos seen during previous tightening cycles in 2022 and 2023. This isn't just a matter of adjusting portfolios or preparing for a dip in the markets. The potential for higher rates is a systemic threat. It affects everything from banks and housing to trade, personal debt, and the value of the dollar. And at the core of Dimon's warning is a message that the broader market is ignoring major risks and operating under a dangerous sense of complacency. Inflation is creeping back, and slowly. Jamie Dimon's comments start with a recognition of what's becoming increasingly evident. Inflation isn't gone. In fact, it may only be beginning to re-accelerate. One of the key contributors to future inflationary pressure is tariffs. While tariffs may seem like a simple trade tool, their impact on prices can be both powerful and delayed. According to Dimon, these tariffs won't hit the economy all at once. Instead, companies, both domestic and international, are expected to gradually raise prices in response to higher import costs. As these price increases trickle down to consumers, inflation will rise in a slow but steady fashion, impacting consumer sentiment, spending, and economic output. This delayed inflation effect, he warns, is not fully appreciated by investors or policymakers. It's precisely this slow-burn nature of inflation that could force the Federal Reserve's hand once again. The odds of rate hikes are higher than the market thinks. The current consensus in the financial markets seems to be leaning toward interest rate cuts, either this year or early next. But Jamie Dimon strongly disagrees with that narrative. He's publicly stated that there's a 40 to 50% chance of additional rate hikes, not cuts. Why does he think this? Several reasons. First, Dimon points to tariffs, which we've already discussed. Second, he highlights the inflationary pressures from new immigration policies in the United States. These policies may lead to higher labor costs and added stress on public services, both of which contribute to inflation. Third, and perhaps most critically, the federal budget deficit is ballooning. That's inflationary in itself, as increased government spending and debt servicing add more money into circulation. Dimon argues that these three forces, tariffs, migration pressures, and fiscal deficits, are not being priced in properly by the market. While current market models are estimating about a 20% chance of rate hikes, Dimon believes that risk is at least double. Complacency in the market is a major concern. One of the most troubling aspects of Dimon's warning is his view that the market is underestimating risk. According to him, investor sentiment is far too optimistic, especially given the geopolitical and economic uncertainty looming over the global economy. For example, the S&P 500 has recently hit all-time highs multiple times. This bullish behavior has occurred despite the complete lack of meaningful progress on trade deals, worsening tariff announcements, and rising fiscal pressure. Back in February, new tariffs proposed by the administration sent markets into a tailspin, dropping the S&P 500 by 21%. Since then, the index has bounced back with a 30% rally, fueled more by hope than fundamentals. Even though there's been no resolution to the tariff disputes and no substantial new economic growth data, the market continues to rally. Dimon warns that this rally is based on misplaced optimism. If trade negotiations continue to falter and tariffs increase, especially to the proposed levels of 30% or higher, the market could crash hard, potentially wiping out recent gains in a matter of days. Trade tensions continue to escalate. Tariff policy is one of the most volatile and unpredictable levers in current U.S. economic policy. Over the past few months, the timeline for new trade deals has been repeatedly pushed back, from April to May, then June, July, and now potentially August 1st. This endless string of delays creates more uncertainty, and with each delay, the risk of harsher tariffs being implemented increases. The situation is further inflamed by escalating threats of tariffs on key sectors. Proposals for a 30% tariff on goods from the EU and Mexico, as well as potential tariffs on Brazil, remain on the table. There have also been dramatic declarations about the possibility of a 200% tariff on imported pharmaceuticals and semiconductors, critical components of healthcare and tech industries. This trade environment adds enormous stress to companies trying to plan for the future, and it also adds inflationary pressure across the board. If high tariffs go into effect, the result could be catastrophic for corporate profits, stock valuations, and consumer purchasing power. Higher rates could trigger another banking crisis. Diamond also revisits the consequences of high interest rates on the banking system. In 2022 and 2023, the U.S. experienced a mini banking crisis triggered by aggressive rate hikes. Major banks like Silicon Valley Bank, Signature Bank, and First Republic Bank collapsed. But they weren't the only ones on the brink. Many regional banks struggled under the weight of losses on long-duration bonds and real estate exposure. A return to higher interest rates could push these fragile institutions back into dangerous territory. If rates exceed the prior peak of 5.25 to 5.5%, the risk of systemic banking failures rises dramatically. Institutions such as Bank of America could be staring down billions in both realized and unrealized losses. And if that happens, emergency funding measures, like the Federal Reserve's repo facilities, would likely be activated once more. The 2023 crisis may end up being just the first wave. A second wave of collapses would damage confidence, restrict credit, and severely hinder economic activity. The consumer is not immune. Of course, banks aren't the only ones who suffer in a high interest rate environment. Consumers are already feeling the pressure. Credit card debt and auto loans are at all-time highs, and higher rates would only make these burdens worse. With interest rates climbing, the cost of borrowing increases across the board. Mortgages, student loans, and personal loans become more expensive. Many households are already operating on thin margins. If monthly payments rise sharply, default rates will rise as well. Consumer spending, which makes up about 70% of the U.S. economy, could take a major hit. That reduction in spending would further drag down GDP and stall business growth. The data already reflects a troubling trend. U.S. GDP shrank by 0.5% in Q1. If another quarter shows contraction, the economy would technically enter a recession. And with business investment slowing in response to high borrowing costs, the chances of another negative quarter are growing. The national debt and budget deficit compound the risk. Higher rates also make it more expensive for the U.S. government to borrow money. The federal government is already paying close to $1 trillion annually in interest. If rates rise further, that cost could jump to $1.5 or even $2 trillion per year. This will increase the federal budget deficit even more, forcing the Treasury to issue more debt just to pay interest on the existing debt. As debt levels rise, investor confidence in U.S. fiscal policy may begin to erode. That could push U.S. bond prices down and yields up even further, creating a vicious cycle of rising borrowing costs. The dollar and U.S. bonds may decline in value. Another risk Jamie Dimon warns about is the weakening of the U.S. dollar. If interest rates rise while inflation remains sticky, and if U.S. debt continues ballooning, international confidence in the dollar could waver. Foreign investors may begin to look elsewhere for higher returns and more stable environments. As a result, U.S. bond prices could fall, pushing yields even higher. A falling dollar would also increase the cost of imports, further fueling inflation, especially when combined with high tariffs. This means the everyday cost of goods would continue rising, decreasing the purchasing power of U.S. consumers and worsening economic inequality. A recession could be around the corner. The convergence of all these factors, sticky inflation, potential rate hikes, banking instability, trade tensions, high consumer debt, and government overspending, makes for a highly unstable macroeconomic environment. If any one of these factors worsens, the risk of a full-blown recession skyrockets. Dimon's warning should not be ignored. While markets have been optimistic, believing that the worst is behind us, the reality may be that we're still standing on a very fragile foundation. Investors and households alike should be cautious. It may be wise to reduce some exposure to risk assets, lock in profits, and consider hedging strategies. The belief that the Federal Reserve will imminently cut rates may turn out to be dangerously premature. Jamie Dimon's 40 to 50% probability of further hikes should be taken seriously. Inflationary pressures from tariffs, immigration policy, and fiscal deficits aren't going away. If markets continue to ignore these signals, the correction could be swift and painful. Prudent investors should stay alert, keep an eye on the Fed, and prepare for the very real possibility that higher rates and a slowdown in the economy may soon collide. That was all from us today for this video, folks. For more similar content, make sure to subscribe to the channel. See you in the next one.